September 2024 macro webinar, asking the main question, how many cuts? So this month I wanted to do something a little different than what I've done in past months. Instead of looking at sort of a bespoke set of information across the various economies and talking through and giving that synthesis based upon all those sort of individualized or tailored perspectives, I wanted to scan across the major developed economies using largely similar charts across each to really help give perspective on the biggest thing that I think is going on in the markets right now, which is the expectations of an aggressive easing cycle by developed world central banks, despite the fact that inflation remains elevated and economic conditions remain pretty good across most of the developed world. And so let's get into it. I'll start with this chart in the US, which I think is probably the most important chart in terms of what's going on today. And here, the green line is the target rate, and the blue line is the 2-year interest rate. And so what you can see here is that the 2-year interest rate is trading way below, about 175 basis points below the current Fed funds target rate. And what this effectively means is that market participants expect that interest rates on average over the course of the next 2 years will be 175 basis points lower than they are currently today. And essentially what that means is that there's going to be an aggressive rate cutting cycle, as much as 225 basis points over the course of the next 12 months and continuing thereafter. That's the path of monetary policy that's necessary in order to get the type of 2-year interest rate pricing that we're seeing. And so what that means is that at its core, what we're seeing across the economy or across markets is this expectation of a very, very aggressive Fed cutting cycle ahead. Now, I think it's important to connect that to what's actually going on in the real economy. If you look at what's happening with growth conditions, they're on the left-hand side, a couple of different measures, real GDP. We also have, final sales to domestic purchasers and final sales of domestic producers, all just different lenses to understand what's going on comprehensively with the economy. And what you see when you look at this is that despite the fact that interest rates have been elevated for an extended period of time, what we see here is that real GDP in the United States, real GDP growth, has remained, depending on exactly how you measure it, between 2 and 3%. That's pretty good for an economy that has a prime age workforce growth rate of, below 1%, and productivity on a longer term trend basis that is, 1% or so, maybe 1.5%. You put that together and you get an outcome where this level of growth is creating a level of prime age labor force participation that is at multi-decade highs. While there's a lot of focus on the unemployment rate, that unemployment rate, of course, is at the economy-wide level. It's still pretty low, all things considered, at 4.2%, having ticked up somewhat from last year. But when you look at essentially the core workers, the folks who are, in their prime age working days, what you see is that basically, it's been a long time since we've had this level of employment, and that hasn't really changed much over the course of the last year, despite the unemployment rate rising. Most of the unemployment rate rise has actually been amongst younger cohorts below 25. So reflecting the fact, and has also been a function of the fact that we've gotten a big rise, an increase in new supply, people coming into the labor market. And so that can overstate the weakness on the economy-wide level, whereas when we look at the core of what's going on with the labor market, it still looks pretty strong, not much deterioration here. So reasonably strong economic conditions, fine economic conditions, labor force participation or labor force or employment amongst the core of the economy, at all-time highs, and still dealing with the persistence of elevated inflation relative to the Fed's target. Now, here on the left-hand side, I show both CPI, which is, currently running in the low threes and expected to basically stay at the same level, about 3.2%, based upon what's expected in tomorrow's report, core CPI year over year. And then, of course, we have core PCE, which is a little bit lower for a variety of technical reasons. You could see it's generally lower than CPI, which is still running in the mid twos, both of which are clearly above what the Fed's target is, and with relatively challenging comps through the back half of the year, it's unless there is a surprise deceleration in inflation and measured inflation, odds are that these numbers will remain elevated compared to the Fed's target. And probably even more important than the nuances of exactly the timing of year-over-year inflation and the comparables ahead is the composition of inflation still reflects the fact that there is a fair amount of embedded inflation pressure in the economy. On the right-hand side, I've broken down inflation into two different pieces, which is the services side as well as the goods side. And I think it's important to recognize, if you look at that blue line, what you see is that a big driver of what we've seen in terms of the disinflationary environment has been a function of core goods prices falling rapidly. In fact, the pace at which they're falling today is the lowest pace that they've been, essentially the most negative that they've been for pretty much the last 3 or 4 decades, except for a short period in just after the 2000 bubble crash. And so what we're expecting to believe that that the current level of inflation will persist for an extended period of time is really quite a bet on the fact that these core goods prices will continue to fall at the pace that they've been falling in the recent period. And so, that certainly is a big part of what's happened in terms of price growth, is that we've seen a transition from, the rises that occurred during the supply chain disruptions to now some of those prices normalizing. But at some point, those core good prices are no longer going to be normalizing. And what they have to do is keep falling at the same rate to get this level of disinflationary pressure in the economy. At the same time, when we transition over to the services sector, what we see is that services inflation in the US remains elevated. Of course, part of this is the housing story, but services X housing, core services X housing also remains elevated, reflective of the fact that nominal wage growth in the United States remains elevated compared to where we were in a pre-COVID period. So you add that all up, and basically drawing a straight line to say inflation is beat is a big bet that core goods inflation is going to continue to decelerate as rapidly as it has, essentially into the future, and that we're going to get enough labor market weakness that's going to bring down services price inflation, which, as I show on the first chart, we really haven't seen all that much labor market deterioration over the course of the last year or so. That has to be contextualized with this story, which is essentially the most rapid interest rate cuts. The only time we've seen interest rate cuts at this pace has been in the depths of the financial crisis and the depths of the 2000 tech bust. And so at this point, the market is all in, not just on cutting rates as a function of some moderation of inflation, but way beyond that, essentially pricing in a near certainty that we're going into an immediate recession, which would cause the Fed to need to be aggressively accommodative, given the pricing, at a time when things are fine. And with stock markets at all-time highs and spreads at all-time lows, it's not like there's a lot of pressure from the financial economy to create a meaningful slowing of the U.S. economy here. Now, scanning to the next spot on our map, which is Europe, we see basically the same dynamic in place, where there has been one cut that's happened so far, but the target rate remains about 140 basis points above what the 2-year interest rate, the German 2-year interest rate is. reflecting the fact that there are expectations of very aggressive European cuts ahead. That's coming at a time when the unemployment rate is at multi-decade lows, and services inflation, headline inflation continues to be elevated, core inflation continues to be elevated, and in particular, the service sector inflation, they're shown on the right-hand side in the gray line, is really moving in the wrong direction when it comes to the ECB's goals here. And so in that circumstance, a tight labor market, pretty good wage growth as a function of that, pretty poor productivity growth, elevated services inflation, elevated core inflation. Again, you have to come back here and say, look at what's priced in, an aggressive easing cycle in the context of an economy that continues to have above target inflation and relatively tight labor markets and decent growth for the European context. Not necessarily booming growth in any absolute sense, but growth that is strong enough, given the productivity, to continue to keep labor markets relatively tight. The UK, another similar story, which we see here. In this case, slightly less aggressive, but despite, we've had one cut so far, and we're still seeing 2-year interest rates trading about 100 basis points below the current interest rate level. It's notable that implies an aggressive easing cycle coming out of the UK, which is notable considering the speech at Jackson Hole from the BOE governor, that the desire was to be, that inflation is not necessarily beat, that you can't necessarily call victory, and that the BOE intends to be slow moving in its behavior ahead. And there's good reason for that. When you look at the underlying fundamental conditions in the UK, on the left-hand side, the unemployment rate roughly at secular lows. We saw another print this morning that was, that was even better than what is shown on this chart. And you see inflation that continues to be elevated, particularly driven by services inflation, which is particularly driven by wage inflation, which is keeping overall inflation up. And in fact, the BOE, by its own projections, expect that inflation will remain above target over the course of the next 18 months or so. And so, connecting back to what's going on in terms of the market pricing, you see a very aggressive cutting cycle priced in at a time when, growth conditions, if anything, are perking up a tad. And you're seeing, strong labor markets, strong wage growth, and elevated inflationary pressures. Australia, another example here, where the RBA has been hesitant to cut, given the continued inflationary pressures in the economy. Yet 2 years are trading about 70 basis points below what the current target rate is. Maybe not pricing in quite as an aggressive set of cuts as in other locations, but still a pretty significant easing cycle priced in. And this is coming at a time when employment as a share of the population is also at secular highs, pretty stable and at secular highs, and where we continue to see Australia inflation well above the RBA's target, predominantly driven by that elevated services inflation. And the RBA has been very clear about their hesitancy to enter an easing cycle, given this combination of pressures, certainly pushing off expectations of cuts in the short term and raising questions about whether they have the ability to cut interest rates much at all, given the underlying inflationary pressures that they keep seeing in the economy. Now, Canada, I think, is an interesting case because it is one of the places where there's a significant easing cycle priced in, but where the macroeconomic conditions align with the type of conditions that would occur in, the type of conditions that align with an aggressive easing cycle. And so, most people don't really care about Canada. It's pretty small, all things considered. For macro investors, it's a market to trade. But I think, if anything, it's for most investors, for broader investors with a broader perspective, I think it's uniquely interesting because what it does is it gives you a sense as the type of economy that where these conditions are appropriate, where conditions are aligned with a big easing cycle. And so you see some easing has already occurred and further easing is expected ahead. And what's happening to align with that? Well, you're seeing basically a rapid deterioration of the labor market conditions in Canada. We've seen the unemployment rate rise about 1.5 points, give or take. And its deterioration is accelerating. And particularly if you start to look at some of the private sector dynamics that are going on, the deterioration is even more acute and more rapid. And while Canada continues to get a relatively elevated amount of immigration, this is not a labor supply side story. This is a significant deceleration in the rate of job creation in the Canadian economy. And so you're seeing deterioration, you're seeing some acceleration in that deterioration, you're seeing a level of unemployment that looks more mid-cycle relative to what was going on in the previous cycle. This is not a great scenario. And you also see growth that's running at about zero for an economy that has relatively strong employment growth. So a per capita GDP number, which is pretty clearly negative. And so that's an economy that needs some stimulation. It certainly doesn't need restrictive interest rates. And you also see on the inflation side, inflation has come down. The Bank of Canada has a slightly different mandate because it's got a 1% to 3% mandate. But you see basically that most inflation measures are basically at that 2% level, well within their target range. And so this is the type of economy, a rapidly deteriorating labor market, one in which inflation is already back to the mandate, where it makes sense to normalize interest rates, to reduce restrictive interest rates in order to support the economy. But that's a story that's totally different than what is going on in places like the US, Europe, and the UK and Australia. Very different story, similar pricing, but a very different story. In fact, the pricing in the US is far more aggressive over the course of the next 12 to 18 months than it is in Canada, despite Canada having much weaker conditions in place and a more explicit commitment to an aggressive easing cycle. Of course, in the developed world, the one outlier is in Japan. There's been a lot of talk in the sort of milieu of the macro world about how Japan is likely to enter a tightening cycle. There was some commentary from Japanese policymakers at the BOJ, speaking to the parliament there about the desire to normalize interest rates. But certainly the markets have not really taken that to heart. Currently Japanese short rates are at 25 basis points after the hike that happened a little bit earlier this summer. And 2-year interest rates are, basically at the mid 0.3% range, or pricing in about a 15 basis point increase. That's certainly within the range of, we'd call this not much tightening priced in expected in the short rate market. And that makes a lot of sense when you look at what's going on in Japan. There's no real reason to tighten in Japan. If you look on the left-hand side, we show real GDP. The level of Japanese real GDP is actually below what it was in the pre-COVID period. That's, considerably weaker than what we've seen in other developed economies. And Japanese core inflation has moderated considerably, and really for the last year has been running, give or take, around 1%. That certainly doesn't make Japan look like they have an inflation problem or any urgency to tighten. And so it was not too surprising when we saw today that several members of the BOJ came out and said that there was very little urgency to tighten further. So what tightening has occurred there has been through the exchange rate over the course of the last couple of months. And that move in the exchange rate will likely translate into lower price growth or slower price growth in headline inflation as well, helping them bring down that slightly elevated headline number in order to sort of, basically the overall picture there is, weak economic conditions, weak inflation, and more of the malaise that we've seen over the course of many decades. No urgency to tighten in Japan. I'll wrap it up with one last place here. Turning our attention to China, the Chinese debt depression, and I use the word depression not to be bombastic. I use the word depression to describe a dynamic. A depression is one in which their debt levels are sufficiently high that despite a decline in interest rates, the private sector in particular is not in a position to take on more debt in order to create an economic reacceleration in response to the policy easing. That's what a depression is. Could also be called a deleveraging, but it's really it's meant to describe a dynamic where we've broken out of a cyclical dynamic and we're now in a self-reinforcing debt-driven downturn. And I think the Chinese markets are really highlighting that. We're seeing stocks move back to decade plus lows here. And we're seeing the bond market also start to continue to, or we're seeing the bond market continue to fall to decade plus lows as well, despite the fact that, on both sides, both in terms of the equity market and in terms of the bond market, various policy initiatives have been put in place in order to intervene in those markets to prop equities up and to have bond yields not fall nearly as fast. And despite those circumstances, you see the markets just keep pushing and reflecting more of this deleveraging or depression dynamic that's going on in that economy. That's the short story. A little different, I know, than some of the previous presentations, but I think the goal here really was to sort of look through across everything. The biggest cross-cutting dynamic is this dynamic that there is a relatively significant global easing priced in across these markets. The economic conditions do not align with a significant global easing. And the biggest story that we're going to see over the course of the next 3 or 6 months is a recognition of this disconnect, particularly in the bond market, as central banks are likely more hesitant to ease relative to what we see priced into the market.